Hello and welcome to this October 2024 Investment Outlook video from Fidelity. I'm Ed Monk and I'm joined today by the Outlook's author Tom Stevenson to answer your questions about where Tom thinks markets are now and where they may be headed in the months ahead. Now, Tom, as always, we've asked Fidelity investors to submit their questions to you in advance, and I'm pleased to say that a great many of them have done that. I'm just going to add here that these are Tom's view of the market. It is not investment advice, but should be seen only as guidance. Well, that said, let's get into those questions, Tom. And I'll say that we've had, we always have questions that cluster around certain topics. The most dominant theme this time, unsurprisingly, 30 or so days before a budget, is the upcoming budget and the possible changes that might be in it. So the first question on that theme, Tom, is this. Would it be sensible to take the tax-free sum available in my drawdown pension prior to the coming budget?
Right. I mean, yeah, I'm not surprised there are lots of questions about the budget. I mean, just anecdotally, when you talk to people, friends and family, everyone's talking about potential changes to taxation. So this pensions are one of the areas in the frame that we think there may be some changes. So this tax-free, let's just set out what the issue is here. That at the moment you can take, when you draw down a pension, you can take 25% of it tax-free up to a rather arbitrary limit, £268,275 from memory. And the reason it's that number is because that was 25% of the old lifetime allowance, which has been abolished. Mm-hmm. So the speculation is that one of the things which Rachel Reeves might do in the budget is to reduce the amount of, or abolish altogether, or just simply reduce the amount of that tax-free allowance. And a number of think tanks have suggested that maybe 100,000 would be a more sensible limit. And that actually coordinates with the sort of average pension pot of most people in their late 50s and early 60s, which is about 107,000. I think. So that is a possibility. And that would be a very significant change for someone who had a big pension pot. I mean, someone who was looking to take advantage of that full £268,000 allowance. You know, if it went down to 100,000, that would be tens of thousands of pounds of extra tax they'd be paying. So, I mean, the answer to the question is, if you think that that's likely, well, then you may want to act on that. But I think, generally speaking, we would always say that acting on speculation is not always a good idea. We don't know what's going to happen.
Yeah, there's loads of things to say here. Definitely, we've seen, and there's lots of evidence that people have been acting ahead of this announcement based on speculation, basically, pulling out money because they don't want it to be taxed in the future. And there's some really important things to say about that. The target of reducing tax-free cash in general terms, it'll be very unpopular for all sorts of reasons. Very unpopular because obviously it's extra tax for people. Particularly, it's extra tax for public sector workers and anyone actually in very generous final salary schemes. They have the most generous pensions and they have these higher amounts of tax-free cash because of that, basically. So people on relatively modest or middling earnings are going to be affected by any big reduction in tax-free cash. That's the first thing to say.
And many of these people, incidentally, have benefited from pay rises recently from the same government. So there's a kind of contradiction there.
Yeah, if the government were to suddenly take lots of tax from those people, it wouldn't seem very coherent. But I think most importantly, the idea that they would apply that tax retrospectively, that change retrospectively, and therefore make withdrawing your money kind of worthwhile, I think the chances of that happening are very, very slim. I don't think anyone expects that to happen. And the reason for that is that it would very significantly alter plans that people have made. They've contributed money based on the system in place at the time and the rules in place at the time. And they've assumed that they're going to get this 25% tax-free. That might be to pay off a mortgage, or they might have already put down payment on a house they're buying. All sorts of commitments they may have made with that money, that were the government to then change that retrospectively, they would face huge challenges in doing so, right?
There's a fairness issue here and also it's not just fairness, but it's the kinds of behaviours that you would be seen to be penalising would be prudent behaviours to prepare for your retirement in a sensible, prudent way.
And there's precedents in terms of previous changes that have been made to the pension system. So we had the lifetime allowance, which was actually abolished just recently, but it had been falling, that lifetime allowance, over the years, and at various points governments have lowered it. But when they've said, well, if you've got money in a pension above that limit, there's a transitional arrangement.
They've attempted to mitigate
they've mitigated it. And another example from recent history would be the equalisation of the pension age for men and women. So lots of women faced this sudden or relatively sudden increase in their pension age from 60 to 65. Lots of them weren't aware that was happening, and they won challenges and they won rulings in their favour to say, yes, the government has a responsibility to inform people in good time about these changes which are going to affect their pension planning. I can't think of a change that would more affect someone's pension planning than this reduction in 25% tax-free cash. So the idea that they would do it retrospectively, I can't see that.
I agree. It would be super unpopular, and the government will be extremely cognizant of the outcry that happened with those WASPy women that you mentioned.
But let's just have a couple of caveats. One, doesn't mean they won't do it. Just because we say it will be unpopular doesn't mean they won't do it. Secondly, they could move to, say, a limit of £100,000 in the future for money contributed now. It would be hideously complicated, but they could do it. Like a lot of changes in the pension system, they could make these changes. They might be difficult. We had reports at the start of this week around the general level of taxation relief in pensions. The government seems to be backing away from that change. That's another one that they've often talked about. Could they equalise, apply a flat rate of tax relief? When you get close to these changes, you realise how difficult they are to make. Not just politically, technically, the communications that have to go into it, the behaviour, as you say, the behaviours that it would punish. It's not as simple as just grabbing tax.
It's not as simple as that, and I think that, very often in the run up to these events, these budgets, you get a testing of the waters, and it feels like this might be an example of that.
Yeah, and they might back away from the change. They've been criticised actually for not killing off these rumours because people are making these changes based on it. So we always have to keep open the chance that they could happen, but I think that's a thorough answer to that question. So let's move on to for now, Tom. Another budget one, though, however. Do you think there are likely to be changes to stocks and shares ISA rules in the budget? And if so, what are the government's options? So ISAs, another popular part of the saving system.
And I think that's the key point, that the ISA system, the ISA framework is extremely popular, and it affects very many people. I think it's about 12.5 million people have ISAs in this country, but it is a generous tax break, and the level of the contribution allowance to an ISA has just gone up and up over the years. I mean, it's now at £20,000 a year, 40,000 for a couple. So it's a generous relief. There has been some talk about limiting that, having a kind of lifetime cap on the amount that you could save into an ISA. That again seems a little bit implausible to me, or rather it seems at odds with the change that was made to the lifetime allowance in pensions. So abolish one lifetime allowance and introduce another one seems a little bit unlikely. So I think of all the changes that might be made, I think the stocks and shares ISA feels like the least likely.
Yeah, and they've actually killed off one change that was due to happen, which was a British ISA, an extra allowance for British investments. We won't go into the details of that. It's basically something that came along just before the election and was killed off when the Conservatives lost that election. The point about a lifetime limit, it could be an odd thing for them to introduce at this stage. However, they probably are going to have to look at some point at ISAs, because as we go, I don't know when they introduced the £20,000 lifetime limit, maybe 10 years ago. As the years go by, you're going to have more people wealthy people by definition who have put that level of savings aside inside ISAs. They're going to build up very large sums inside ISAs where gains are completely tax-free, the income is completely tax-free. They're going to be able to use that income in their retirement at a time when other people are facing taxation on their pension income. And that's going to be, the optics of that are going to be bad. You're going to have a situation where ISAs, for those who've really been able to take maximum advantage of them, really are very generous as a kind of income generation tool, right?
Yeah, so it's this intergenerational fairness thing again, and another thing which seems to favour, the boomers at the expense of people that come after.
Yeah,
it's hideously complicated, isn't it? All of these tax issues.
It is. But again, nothing's off the table at this point. They could make these changes. The next question, Tom, what do you think Labour will do with CGT? Another tax.
Yes, I mean CGT is, and this is an interesting one because CGT is probably of all the taxes is probably the one that feels the safest for the government to go after because it feels like a rich person's tax. Most people don't make significant capital gains, or the capital gains that they make are sheltered within an ISA or a pension. So to be paying capital gains tax, by definition you are a wealthy person, and also the capital gains tax regime is very complicated and messy. Really, there are different rates. There are different rates for capital gains on property as opposed to other assets and businesses. There's a different regime for so-called carried interest in the private equity world. It's a very complex area. So I think one of the things which we might see happen in the budget is a simplification of the regime. So we've got a 10% rate of CGT. We've got an 18%, a 20%, a 24%, a 28%. I could quite see those being internally equalised so that we just end up with one CGT rate, say 24%.
Yeah,
that's one possibility. But what people tend to talk about when they talk about equalisation is an equalisation of the capital gains tax rate and the income tax rate, because capital gains are currently taxed more favourably than income, which possibly seems unfair. Yeah, I think that's quite unlikely.
Yeah, we always will talk about CGT first and foremost in the context of investments, I suppose, because that's what we sort of do. But of course, lots of people pay CGT when they sell businesses. There might be sort of different considerations there. I think it's true what you say. If to pay CGT on investments means that probably you've maxed out your ISA allowance. You've probably got big savings in pensions as well. So when it comes to paying that tax, which actually you would have been able to avoid a lot of anyway because of the allowances that you get every year, that's definitely changed and more people have been brought into the scope of that tax, but it's still, as you say, kind of a rich man's tax really when you look at the big picture. And for that reason, the government could go after it, especially considering the areas they've ruled out of tax rises.
Yes, yes, exactly. I mean, they've ruled out income tax, VAT, national insurance. I think the thing about CGT is there's a kind of philosophical point here, though, that Rachel Reeves has made a big point about saying this is going to be a budget for investment in the future of the economy, growing the economy, increasing productivity, and so going after people who have taken risks, built businesses, and then punished them is, again, what's the coherence there? That's the challenge for her, one of the challenges.
Okay, last question on the budget, Tom, I promise. If Rachel Reeves changes inheritance tax rules, can they be retrospective? Can they start on the 1st of November, or will they need to wait until the new tax year next April? So a couple of things there, actually.
Well, I mean, we've talked about the problems of making retrospective changes. I think inheritance tax is another complicated tax. There are different allowances that some relate to property and some relate to everything else. There's the issue of being able to pass on your allowance to a spouse. Yeah. So that's a complication. I think one of the things that maybe the government would want to avoid is a allowing people a period of time in which they could mitigate the impact of changes in a tax. We saw that going way back then when in the 1980s with the abolition of joint MIRAS, mortgage interest rate at source relief. And what happened was that the Chancellor then, it was Nigel Lawson, I think, basically put in place, he said, we're going to do this in March. He said, we're going to do this in August.
Yeah.
And that created all sorts of unforeseen consequences in terms of people started acting on the basis that this was going to run out in a few months' time. So I think they might want to avoid that, but that's not quite the same as saying retrospective. That's just saying there won't be a future window of opportunity.
Yeah, they're not going to make a change which, people can sort of, just by acting now, can sort of avoid or dodge or what have you. So if it's a change like that, then it probably will be made, from midnight. But again, as you sort of hinted at there, the principle of applying a different set of rules to money which has been planned and finances which have been planned under one set of rules, it doesn't feel fair. They can do it because they're in charge of the tax system ultimately, and I think with inheritance tax, it's worth saying it doesn't raise all that much money. It's an emotive tax. People see it as fair game, as a sort of wealth distribution tool, but also the people who pay it often feel that it's a double taxation or a sort of a tax on a very natural feeling of wanting to pass on wealth to your loved ones. But I mean, I think it raises half as much as CGT, less than half as much, and so even if you were to double the amount, it's still not really going to move the needle that much on the overall tax.
And that's a general point that we can make about all these changes that we're discussing is that the Chancellor in the run up to the election ruled out changes in the big taxes, the big revenue earners, income tax, VAT, national insurance, and you could argue that she's painted herself into a corner unnecessarily on that. Yeah. Obviously, she had an election to win, but it does mean that these other taxes have to work very hard to, as you say, move the dial. Yeah,
but which is not to say there might not be something on IHT, because there is so many, levers within that system, thresholds, rates, allowances that can be, we were speaking just before we recorded about the 7-year rule, this idea that you can gift money and then have, as long as you don't die within the next 7 years, it basically becomes, escapes the tax. Yeah. They could change that.
They could, but again, that's hideously complicated because someone has made a gift on the basis of that rule and they're planning to live for another 7 years and then the rules change. Yeah. It's a fairness issue.
Okay, so not a very clear answer there. We don't know, is the truth with these budget questions. We don't know what's going to happen, but I hope we've given some of the considerations that will be in the government's mind. A new topic, Tom. How will the conflict in the Middle East affect the financial conditions and markets around the world? Yeah, this is on the minds of lots of questioners.
Yes, and we've had a few sort of trial runs at this in recent years when we've had people said, well, what impact would the invasion of Ukraine have, and often the impact of these geopolitical tensions, wars, is actually rather less than you'd think it might be. I suspect that the key area here is obviously this being the Middle East. It's to do with the oil price. There was a lot of speculation, and the oil price has been pretty volatile in the last week or so after that barrage of missiles, and the question was, would Israel retaliate? And if so, how would they retaliate? Would they strike at Iranian oil-producing assets? So, and the oil price has spiked a bit on the back of that. So the oil price is an interesting one because it could work two ways. It could be inflationary. The oil price is, a higher oil price is by definition inflationary because it's a big part of everyone's spending. But it could also be deflationary if it triggered a recession. So,
or one then the other might happen.
Yes, exactly. You could have an inflationary spike which then caused a recession, which currently is not the central case. Everyone is talking about a soft landing for the economy. patting the Federal Reserve on the back for managing to tame inflation while avoiding an unnecessary recession. This could be, people talk about the October surprise before a presidential election. The big event which no one was really expecting, which actually changes everything. And what's going on in the Middle East has the potential to change everything.
And the stock market's reaction to these things, we've sort of become used in recent years to bad news on the economy being taken actually quite well by stock markets, because they see that as a reason for central banks to be very accommodative with their monetary policy, lower rates or lower them quicker or keep them low. We've seen a bit of a shift, haven't we, this year, where basically good news for the economy is actually taken as good, genuinely good news for the stock market, and things that might slow the economy down, people see that as a bad sign for the stock market.
Yes, and I think the reason for that is where we are in the cycle. So we've been through a period of a couple of years where interest rates have been rising in order to tame inflation, which is good and the right thing to do. But we're now at that tricky point where people are asking the question, has the rise in interest rates led to a situation where we're about to go into recession? That's what we don't know. So I think that's why bad news is starting to be treated as bad news, because we're potentially on the brink of an economic slowdown.
Yeah, and we should say, of course, that markets are at quite high levels already. So when this news comes along, it does have the potential to cause quite big movements in share prices, right?
Yeah, absolutely. I think, not all markets, but the US market, the world's biggest and most important stock market, is, at an all-time high, is quite highly valued. And so I think is obviously vulnerable to that downturn that we're talking about.
Okay, well, let's stay with the US, because the next question, Tom, is this. What will be the different impacts on markets resulting from the USA presidential election, if Kamala wins or if Trump wins?
Yeah, it's a complicated question. I think there are probably sort of, a few broad areas to think about. One is in geopolitical terms. There are big issues with Ukraine, America's contribution to and relationship with NATO, America's relationship with China. Those are big issues, which would probably be subtly different and sometimes not so subtly different between the two candidates. So that's one area to look at. The other area I think is important is to do with government borrowing and the deficit. There was an article in the paper this morning talking about the potential difference in the rate at which government borrowing and the deficit would rise under a Donald Trump administration or a Kamala Harris administration. I think the feeling is that possibly it would rise more quickly under a Trump administration. So that's one.
And that question would depend also on the nature of the election result in terms of the Senate and the House of Representatives, right? Because of the ability of any president to get through an agenda. If they have a clean sweep of those bodies, then probably they can do more spending if they wanted to.
Yeah,
if they don't, they can't.
And that's a uniquely sort of American consideration because you do have it's essentially a check and balance on the powers of a president. They need to get measures through Congress, and sometimes that's easier if they're of the same party, and sometimes it's quite difficult. And
in terms of like planning and trying to make investment decisions on the basis of this, it's really, really difficult. This is it's all US elections are knife edge from the point of view that it's a two-horse race. It's always going to be really close. This one's very close. We know that. But then even if you knew the winner or were confident of predicting the winner, you don't know the effect really that's going to have.
You don't. And if you look back at history, it doesn't really tell you anything particularly useful, because if you look at those various permutations that you talked about, Republican president, Democrat Congress, and all the other possible permutations, the actual market returns on average over the years are not that different, really. So it's not telling you anything particularly useful. Just the final thing I was going to say on that, though, the final consideration is sort of economic policy. Well, not just economic policy, general policy. Has been a lot of talk about tariffs and whether they would be inflationary. Presumably they would, and also immigration. You cut down immigration, that's almost by definition inflationary. So then you get the issue of inflation coming back, the impact on interest rates, and etc.
Okay, well, let's move on for now, Tom. The next question. Will the tech bubble continue? Will AI make us rich? And should everyone have NVIDIA shares in their portfolio?
Well, I think the tech bubble has been deflating a bit for some months. Since the summer, the performance of those big tech stocks relative to the rest of the market has come off. The market rally has actually broadened out, which is a good thing. I think it makes the rally feel more sustainable. Will AI make us rich? My fear about AI is that it will make some people extremely rich and other people rather less rich. It feels to me like potentially quite a divisive technology. And then the specifics, should we have NVIDIA? Well, that's a very interesting question, because what we don't know is who the ultimate beneficiaries of this IA revolution. I think we can all agree that it is a revolution. It is changing a lot very quickly. But with previous technological revolutions, it's not always been apparent at the outset who the ultimate beneficiaries would be. And NVIDIA has been the sort of poster child of the sort of infrastructure builders, if you like, the people who are putting in place what you need to create all this AI software. They won't necessarily be the main beneficiaries. It may be other companies who are able to build applications and services based on AI, and if you like, ride on the coattails of what the likes of NVIDIA have put in place.
Yeah. Well, a couple of things jumped out at me looking at this question. The first one, should everyone have NVIDIA shares in their portfolio? Everyone probably does have NVIDIA shares in their portfolio, because it's such a large company and takes up such a large part of the US index, which will be part of any US funds, index fund, the global funds will have a fair chunk in all of those companies. I just wanted to talk a bit about the way, the kind of market leadership element of this, and tech has led the way in the first part of the year. Incredible gains for NVIDIA. It cooled off, didn't it, as you said, when there seemed to be some question marks about general economic performance, and there was this idea, again, we said that once upon a time, if that was news came through that the economy was weak, that would have been great for a company like NVIDIA, because it meant that interest rates would be lower. For all the tech companies, that's going to be good. But when that news about a weakening economy, which has actually been reversed somewhat, I would say, but when it came through and those companies fell in price, it was interesting, because I think at that moment people realized, well, other companies are going to have to spend money on AI to kind of fulfill this potential that we all think AI has. But AI is not yet perhaps integral to lots of companies. Maybe it gets there quite soon. Maybe AI is the last thing you cut in a year or two's time, because it's so integral to your business. But at the moment, it feels like a kind of exploratory thing. You want to invest in it to maybe potentially get the benefits down the line. And you need a good, healthy economy and people with confidence to invest in their companies in order to get that.
Yeah, and the other related point to that is that, because everyone is investing so heavily in AI, because they know that they can't risk not investing heavily, because they will be left behind in something that's moving very quickly. Yeah. Because everyone's investing so heavily without really a clear line of sight of what the economic returns on that investment will be. I think the one thing that is safe to say is that an awful lot of money will be misallocated, will be badly invested, and will be wasted. Yeah, and the same happened in the dot-com bubble.
Indeed, and you don't know the challenges that AI faces. One of them we do know about is the energy consumption of AI, which is forecast to be kind of hair-raising, but also the fact that AI needs to be built on other information, content, knowledge that's already out there, and how's that going to be handled? How is it just a free for all? Are we all giving up sort of all human knowledge to AI, and it can now monetize that for their purposes, or will that be challenged? There's all sorts of questions that AI throws up that haven't really been thought about yet.
Well, there are so many unanswered questions about AI, but then there are always unanswered questions about all technological advances. The introduction of the motor car, the demise of the horse. I mean, no one really foresaw what that meant in terms of the development of the global economy. And this is going to be exactly the same. I do think, I think maybe like a lot of people, I was a bit skeptical about AI to start with. I think the more I get to know about it, the more I see the impact of it, the more I realise that this is a genuine revolution. But I still don't know how it's going to turn out.
No. Okay. Well, from a very new thing to a very old thing, Tom, annuities. Is now a good time to invest in an annuity with interest rates being high, but likely to reduce in the near future?
Well, I mean, the level of interest rates is clearly a key factor in determining the attractiveness or otherwise of investing in an annuity. But broadly speaking, higher interest rates are good. You get a better return from your annuity. But the other key factor is, when you buy your annuity. If you're able to leave off buying an annuity for another 10 years, say,
you'll get a better rate.
You'll get a much better rate in the future. So there's more than one moving part here. So I don't think you can answer that question by just saying, interest rates are high, should I buy an annuity? Yeah, I mean, yes, it's helpful.
Yeah.
But and yes, if interest rates fall, annuity rates will fall as well. But I think there are other factors.
Yeah. I mean, in fairness to the question, they've said, interest rates high now, likely to reduce in the near future. That's a correct analysis, really. That is what's expected to happen. So if you're talking about the difference of maybe a year or two in purchasing that annuity, then maybe it does begin to make sense to move now. But that's only if within your wider financial plans, it makes sense to. You don't want to over or under annuitize. There's a good case for using annuities. Guaranteed income, often income that can be guaranteed to rise with inflation or with some mitigation against inflation. That's a very valuable thing to have in your financial mix in retirement. But if you spent all your money on that, probably you're going to be missing out on potential better returns, financially a better outcomes in other ways. So,
leaving aside the fact that you've lost access to that money. Once you bought an annuity, that money has gone. It feels to me like this is a very good time to seek out advice.
Yeah,
it's a complicated question.
It's a complicated question, and an advisor would be able to put all those options and put some figures on them better than we can do in this conversation around what it would actually mean. And also look at other options, limited term annuities. So you just annuitize for a bit, if that suits you. All sorts of options for kind of blending these incomes. But I think, the questioner wants an answer to their question. They're probably correct that it is a good time, mathematically, all things being equal, to look at annuities.
Yes, and you could make the same point about is it a good time to to invest in cash, for example, cash savings. Yes, rates are going to come down. If you can lock it in, then as part of a broader mix of investments, then maybe it makes sense.
Okay, well, our penultimate question, Tom, is this. I have investments in China. Over the last few years, they've performed poorly, but recently they've surged because of government intervention. Is this surge sustainable, or should I be thinking of cashing in now?
Well, I mean, it's been an extraordinary movement in markets over the last couple of weeks. I think the Chinese stock market rose by more than 25% in a week. It was an extraordinary rise, and it was on the back, as the question says.
World's second biggest stock market. I mean, that's a huge, huge amount of money.
It's a massive amount of money. Yeah. I mean, it was a huge swing, and as the questioner says, it was on the back of some pretty big stimulus announced by the Chinese government to support the property market, actually to support directly the stock market as well. So. Is it sustainable? Can it last? I think a lot depends on what people have been saying to me, people who are closer to the markets in China and Hong Kong. They're saying it all depends on whether there's follow through, whether this actually flows through into real change in an improvement in the growth trajectory of the Chinese economy and of Chinese companies. Because ultimately, share prices are determined and track movements in earnings. And the Chinese economy has been very sluggish for many years. I mean, since COVID, it emerged slowly from COVID, The property sector has been on its knees. Consumer confidence is very low. And we need to see some real follow through into the real economy, I think, for this to be a sustainable. Otherwise, it could just be a kind of, a trading opportunity, if you like. Some people have described it as that.
Yeah, and the questioner says, is the surge sustainable? Should I be thinking of cashing in now? But they've also said they've had investments that they've held for many years. And as you said, the fall in China, even with the big increase that we've seen, is still way below the levels of like 2-3 years ago.
Oh, absolutely, it is. Yeah.
So in terms of cashing in, you're probably cashing in at a loss overall if you've held investments in China for that long.
I mean, the key question, of course, is as ever, is not what's happened in the past. The key question is to look at the Chinese market now, to look at the valuations of Chinese shares, which remain cheap even after that 25% surge in a week. Chinese shares were trading at something like 9 times expected earnings. They might be trading at 11 or 12 times expected earnings now. That is still half the valuation of the US market or even the Indian market, come to another emerging market.
And is it fair to say that a lot of the surge last week in China, or 2 weeks ago in China, a lot of people buying in at that stage, they're really buying the hope that this is the start, really, of what the Chinese authorities do, and that those big actions, and they were big, are an indication of its willingness to support, the economy. And actually, that's why people are buying, because they think there's more to come.
And I think that's a reasonable conclusion to draw, because the authorities in China have held back for several years on implementing more stimulus. I mean, if you go back to the financial crisis, the Chinese were really instrumental in getting the global economy back on its feet because of a massive level of stimulus, and they've held back from doing it this time. And so I think a lot of people had kind of given up on the Chinese government ever stimulating the economy in the way that it had in the past. So I think that was the big change, because it really looked like a sea change in the government's approach.
Okay. Well, the last question today, Tom, is this: I have a 12-year-old child. What would be the best way to save or invest for them, in your opinion? So, investing for a child.
Yes, investing for a child. Well, the key thing to say about investing for a child is they have a long time ahead of them in the market. So, I'd say 2 things. I'd say, make sure that you're well diversified, because over that long period of time, we don't know what's going to happen. Lots of things will happen. And some things will do well and some things will not do well over that period of time. The second point I would make is that because they have a long time in the market, I think you can afford to take, some risks. So, be heavily exposed to the equity market rather than, lower risk assets like cash and bonds. So that's but then the final thing I would say actually is, it's this old thing about, do you give someone a fish or do you teach them how to fish?
Yeah.
And I think that's what I would say. If you've got a 12-year-old, they're old enough now to start to actually get interested in the whole process of investment and to get excited about it. So I would spend a bit of time. I think that would be the best investment you could do, is actually in their knowledge and their enthusiasm for investing. I was going to say, introduce them to some good books on investing, but if they're 12 years old, there's no way that they'd read them.
No, that's right, Tom. Yeah, turn off Fortnite and read my investing book. I was going to say, lots of sensible advice there, but it's the thing about the habit forming. Invest the money, sure, but try and convey this message around why it's invested and how it's going to grow and why it's going to grow and why staying invested beyond the age that they can first get their hands on it, which you presume will be 18 or something. Try and keep that money invested for the future. Don't put sure, you might need it for a house deposit or something eventually, but don't say this is money for your 18th birthday. Keep that sort of investing going. I had a conversation recently with someone that was asking about cultural differences between the UK and, say, the US when it comes to these things. And so often you'll hear Americans talk about the college fund, the retirement fund. And those kids imbibe that stuff, don't they? And just the idea that this is something that is a good thing to do, is going to be beneficial one day, keep it going on the regular, spare money in. That's a very, very powerful habit.
And just run through some of the numbers with them. Just tell them what will happen if you can grow your investments, even if you start small. If you grow at 5% a year, you're 12 years old. In 50 years' time, you'll only be 62. Yeah. Run them through the numbers.
Indeed. Okay. Well, that is all the time we have now for questions. Thanks to Tom for joining us today to answer them. If you asked a question that we didn't get round to, then we do have a special edition of the Personal Investor Podcast, which will answer yet more of those questions. You can listen to that on iTunes or wherever you usually get your podcasts. A full copy of Tom's Investment Outlook is available to download at fidelity.co.uk/outlook. Thank you so much for watching, and do join us again next time. Bye for now.